Welcome to this week's Nebraska Soybean Board Weekly Market Roundup, which is brought to you by Nebraska soybean farmers and their checkoff. I'm Bryce Duskett today, filling in for Susan Littlefield, and there's really no sugarcoating about the markets this week. Another challenging week, but joining us to discuss all of that is going to be Arlan Suderman right after this break. We'll be back with that conversation coming up next.
It may be small, but this little bean fuels a lot of power. It powers a food industry as a top source of protein. It's a fuel that powers diesel engines with fewer emissions. It powers a state economy and bottom lines. And it powers the rest of the world as a top Nebraska export. Yeah, it may be small, but we're finding more ways for this little bean to power Nebraska.
And welcome back to the Weekly Market Roundup. Arlan Suderman, Chief Commodities Economist with StoneX, is our guest. He joins us here on the screen. Arlan, I appreciate you joining us here in a week that started out quite troublesome as we opened things up, particularly in the stock markets on Monday. As we look back at the week that it was, maybe starting at the stock market, describe how you saw things, and we'll talk about how that spilled over to what happened in the grain and perhaps the livestock markets as well.
Yeah, we really need to go back to the previous week, and it was the day of the Federal Reserve meeting. That same day prior to the Federal Reserve announcing its decision, we saw the Bank of Japan surprise the market with a rate hike, the largest rate hike they had done in 15 years, lifted their benchmark interest rate into positive territory for the first time in 8 years. That's right, they'd had negative interest rates for the last 8 years. During that time, many investors in Japan had taken a tremendous amount of money and implemented what's called the yen carry trade, where they borrow against the yen to invest in the U.S. markets. So at negative interest rates, they could invest and sell the yen to buy dollars to invest in our markets. That made them the largest foreign holder of U.S. debt, as well as major players in our equity markets. So when you have them doing that, and then our Fed meeting essentially confirming expectations to cut rates starting in September, that meant that it was no longer profitable to stay in that carry trade. They started unwinding that. People misinterpreted what was happening as a disappointment in the Fed. And then the jobs report on Friday being soft, they said, oh, it must mean we're going to recession. And the piling on of selling not only happened here, but around the world as a result. Things have stabilized now. But for a while, what that really did is reinforce the commodity deflation mode for the funds. Like, hey, if we're going into recession, nobody's going to want commodities. So not only get rid of them, but get short on them. And so for those few commodities like live cattle futures, where they still held a long or ownership position, they were quickly liquidating those.
Yeah, we'll talk about livestock maybe here in a second. Arlan, talk about where corn and soybeans are as we sit here on the 9th of August. December corn trading the lowest December prices in over 3.5 years, similar to corn. November beans trading near their lowest level over the 3.5 years. And interestingly, cash prices almost $2 a bushel lower than what USDA production cost estimates are for 2024. Size up the grains in particular. What are you seeing in particular those two markets?
Yeah, rather painful when you consider the level of input costs for this crop, and the input for the 24 crop being higher than even the previous year, and we're still trying to get rid of last year's production as well. So if you look at this going into the August report, December corn breaking below $4, November soybeans below the $10 mark, national average cash right now with a 3 on it in front of corn, and a 9 on in front of it. And for soybeans, not a good place you want to be. So what can we expect out of this report and its reaction? You get surprises in either direction from the August report, but typically it's much more difficult to get a bullish enough surprise from USDA in the August report to really convince the market that the bottom is in. The more likely scenario is that you continue lower here until the market is confident is fully priced in the size of the crops. And considering the generally favorable weather pattern we've had for the bulk of the Midwest for July and now much of August, the expectation is higher estimates today, meaning bigger crops get bigger in the September report.
As you and I are visiting here on Friday, this broadcast coming out today and tomorrow. Let's talk about the Friday trade. How were traders looking at things ahead of that report and getting themselves positioned?
Well, knowing USDA's tendency for surprises, they already held record to near record short positions in these commodities. So we saw them covering some of that just in case there is a surprise. We did get a little bit of support for wheat that gave us double-digit gains overnight based on a shrinking European crop. And that's something for longer term we need to keep in mind because the Black Sea crop has come in much smaller than expected. And that's pretty much been factored in now. We feel pretty comfortable what that is with Russia's crop around 83 million metric tons. Europe's crop, though, USDA has not fully accounted for the lost production there and some of the lost quality. That's more of a factor for the second half of the marketing year for U.S. wheat balance sheets. The same thing as we look at corn, the lost corn production in the Black Sea, expectations of a smaller Argentine corn crop this year and even smaller next year as they shift away from corn acres towards soybeans. But again, that's more last half of the marketing year factor. That's something to look forward down the road when we start to see exports start to improve.
You're just joining us on the Weekly Market Roundup brought to you by the Nebraska Soybean Board. Arlan Suderman, Chief Commodities Economist with StoneX, is our guest. And Arlan, we're talking a little bit about what's going to be coming ahead with Monday's WASDE report coming out from USDA. An interesting note about that is this is the first year that USDA could change planted acreage estimates in that August WASDE report without a resurvey. What are some of the implications of that new approach?
Well, it's a little bit difficult to know which way they can be because there are those who will argue with good facts behind them that the yields or acreage should go down. And because of the slow planting, it just didn't get planted. And there are those who are making an argument for acreage to go up and got good arguments behind it. And without a resurvey, we really don't have a handle on which way it'll go. So there could be a surprise. But what I would say in this case is that changes in yield will probably have a bigger impact on the balance sheet as we go through this fall than changes in acreage. So let's not get distracted by it too much. I do expect harvested acreage to go somewhat down because of some of the flooding problems that we've had in the northwestern Midwest and the major hailstorms that we had in Nebraska. It's interesting to note this week we discovered, USDA never really published it, but we discovered a study they did on the lost acreage due to flooding back in June due to those record rainfalls that we saw in northwestern Iowa, southeastern South Dakota, northeast Nebraska, and southern Minnesota. And USDA's numbers on that are 70,000 corn acres and 46,000 soybean acres lost. Those numbers, I think, are lower than most people would have thought, but those are numbers we can anticipate USDA reducing harvested acreage due to that problem there.
Yeah, appreciate your insights on that. Arlan, you were talking a little about livestock, and they were kind of the spillover damage due to what was happening in the stock markets. Let's pick up the conversation as things kind of tumbled there Monday, Tuesday. We're able to see things close a little bit higher here on a Friday.
Yeah, when we look at the hog market, it really indications now that we've hit our seasonal peak in both product prices and in cash prices. We saw the cash index or the hogs start to work lower over this past week, very incrementally, but moving in that direction. So the funds kind of shifting their positions and starting to liquidate some of their length. Cattle market really took a big hit to start the week as the stock market was crashing. Fears that with the economy feared to be going into recession as they were tying the break in the stock market to recession fears that the consumer wouldn't want to pay up for the higher cuts of meat. And live cattle, as I said earlier, was one of the markets where the funds still had considerable length. And so they were liquidating that length in that market. But when the stock market recovered, live cattle futures didn't recover near as much. And so what we ended up seeing is cash trade moving lower, $3 to $5 lower in the north, about $2 to $3 lower in the south, taking advantage of the basis opportunities. The cash still trading above the board, but the board seems to be comfortable with that. We did finish on a more positive note at the end of the week as the board trying to catch up a little bit to the cash, though.
All right, Arlan, wanted to throw another question out your way, kind of some local news for our listeners and viewers in Nebraska. This week, it was announced that a site was selected in the state for a sustainable aviation fuel production plant using biomass feedstocks. This is the investment reported. Construction could run around $5 billion. Serious investment made potentially here in the state of Nebraska. Want to get your thoughts on sustainable aviation fuel? A lot of news on that over the last 6 months or so, particularly around some tax credits. What's your outlook though for that market?
The big driver is the tax credits, and the big driver of the tax credits really goes back to Europe, because Europe is far ahead in trying to move the aviation industry into a more green energy type of scenario. And there's not a lot of comfort with electricity. So therefore, liquid biofuels is the leader, sustainable aviation fuels. The question is, what will the feedstock be? And right now, the US EPA is not giving a sufficient credit for our ag commodities to be that feedstock. Now, if we're able to get the pipeline moving through that takes those carbons, sequesters that carbon, and puts it underground, that we believe would be enough at this point to get an environmental score high enough to get a credit for ethanol to price in as a feedstock. That would be big for the ethanol industry as we see it. That's not a done deal by any means. We're certainly seeing progress and momentum in that direction. The current administration's not supporting anything more than that. We don't know a lot about the potential Harris administration policies, the Trump administration policies. We don't see much different from the Biden administration. Harris administration, we would anticipate, would still be going maybe even more heavily toward electric vehicles. So therefore, they may not necessarily be behind the liquid biofuels and the support for ethanol as a feedstock either.
Arlan Suderman with StoneX, our guest today here on the Nebraska Soybean Board Weekly Market Roundup. Arlan, thanks very much for the time. We sure appreciate it.
Thank you, Bryce.